what you have right now is a good circumstance to start to invest, especially in the world of the startups, because you have a bunch of startups that are flat in price for the past couple of months, eventually some years, because of the economic dynamic that we got till this moment. So you have startups with a very low price that can multiply your money a lot. Like one of the best startups we're having in terms of moving forward, we're just making a measure of 10x the money, sorry, 100x the money on those companies. But it's just because of the dynamics that were implemented for these past 2 3 years, in which essentially startups got smashed very hard. So you have companies that are extremely cheap. They are effectively with a price that doesn't even match their yearly revenue. So you're buying some stocks in which you're not even getting the price of 1 year of revenue on the stock. And we're speaking about companies that are already in the market for some years. They are on a very good position, and they have been growing extremely well for the past years. Some of them are not profitable, but again, I already mentioned this situation. If you have a company that is just expanding in terms of operating expenses and dynamics, you want to expand your company, you want to put it on different locations on the map. So you have companies that are based in countries like United States, and for the past 5 years they've been expanding throughout the world. And because of the dynamics, they're really cheap, but like they can be even cheaper now than what they were like some years ago, maybe 3 years. And for the past 3 4 years they're just expanding operations, they're increasing in revenue, so everything's going very well, except the fact that the price of the stock is cheap because people will just people just sold essentially for the past 3 years. The dynamics of the economy was not the best for these startups, and essentially the news kind of makes people sell because they say these companies, they're not profitable, they shouldn't be a position in which you should be invested on because you can just lose the money if they go bankrupt. Remember that this is all a dynamic to actually convince you to just take the money out and scare you away. The people that already have their money there, they started investing in these companies like 5 years ago, 10 years ago. It depends on how long the company has been on the markets. So we're speaking about a dynamic that is a long term game. People invest today in order to get a lot of returns in 5 to 10 years, because we're speaking about companies that they start on a local place, let's say a country, and then they take all this time to expand operations, to go off the country they're placed and to the world. And all of these processes take time. So essentially, you want to invest with this time frame in order to catch the bigger expansion of the company in terms of growth and revenues, in order for you to capitalize on your investment the best possible way. So this is how the game is played for the people that already know how things move. What happens now is you have extremely low prices and very good dynamics in some of these companies. You're not hearing about them on the news because the news will just start to convince people to buy the companies a long time after they have been going up in price. Long time, or if they go up very fast but to the upside extremely. So let's say you have one company that just 10x in a matter of 1 month, for example. If this happens, 1 month or it could be weeks, but if this happens, then the media actually may start to cover these companies to attract more people to buy into the companies. And then they just make additional pressure for the stock to go even higher in price. So the idea is you should be buying essentially when no one's telling you to buy on the media. And by the time the media starts to talk about these companies, you should evaluate if you already have a good return on your investment for you to get out, or if there's still some more leg up for you and you can essentially get out in a matter of 1 month or some weeks. Usually, when the media starts to cover these companies, um, at least when we're speaking about the television itself, I would say it doesn't last too long for the upside of the company. Unless we're speaking about a company that is just going to the upside when the dynamic of the economy is still going up as well. Because that can just make the stock going even higher if the dynamic stays the same. So again, this is on a short time frame, it's just a game no one knows. It's unpredictable. So the best position you can have is to set yourself to make your investment and just get a lot of profit of 5 to 10 years. I think that's the best approach you can have because short term no one knows. Effectively, a lot of people like to think about investing on short time frames. But again, it's a game that is very hard to predict. This is very volatile in terms of space. So the company can just go up one day like 50% in a single day. The next day can go down 20%. The following day can go another 30% up, 40% up. You never know what happens on these daily activities, and it's hard to predict. Effectively, the institutions that do a daily operation based model in which they actually have good success, what they have implemented is a algorithm that is able to essentially track all the market movements, all the buys and sells, and they figured out a way to take advantage of the dynamic that is being implemented. And this algorithm is like an automated machine that just buys and sells whatever he sees it's the best place to do that decision. So we're not speaking about humans, we're speaking about robots doing this on a very effective way. And then again, if you think you can compete against something like this, it's very tough. And when I was starting as well, I was taking a look into the possibilities you can do around this space. And I was comparing long term investors with shorter term investors. overall. And what you can see is like people that stays long in the game, especially people that started already some time ago, so like 1 or 2 decades. You see people that are very wealthy. But on the short term approach, you have people that are already doing this for pretty much the same time, and they don't have even close to the wealth the others have. So essentially, you can adopt the best strategy you think it will suit you, but by what you can see, the long term just wins. In fact, there was a statistic that they were saying the best investors are actually the dead ones, because when someone dies and the family doesn't know about the account, the money stays invested, and that's when they get the bigger returns. Some people were saying they get better returns than a lot of investors that are out there for a long period of time, like Warren Buffett. Of course, that it's important to understand if people are investing money, they want to make money, and at some point they just take profits, because that's the point, is for them to use the money. So, of course, if someone's dead, they're not using the money is just staying invested. But it's interesting to understand how staying with the money in the market doing nothing is a very good strategy overall compared to a lot of things you can do with different approaches.